We are pleased to welcome you to today's webcast, Long Island Capital Alliance, Innovative Ways to Raise Capital. Before we begin, we wanted to cover a few housekeeping items. For the best viewing experience, we recommend logging in on a computer, using a wired internet connection, and closing VPN and anything else running in the background that can cause connection issues. At the bottom of your screen are several engagement tools or widgets that you can use. All of these can be moved, resized, or minimized, so feel free to customize your desktop space as you see fit. You can submit questions through the Q&A widget at any time during the presentation. We'll do our best to respond to your questions, but if we run out of time, we will connect with you after the webcast. Please note that CP credit is not available for today's webcast. I will now turn it over to Eric.
Thank you, Lexi. And on behalf of the Long Island Capital Alliance and our chair, Michael Lane, welcome to this morning's webcast, Innovative Ways to Raise Capital. The Long Island Capital Alliance assists local companies in raising growth capital. During non-COVID times, we host quarterly industry-focused capital forums at which businesses at all levels of development have an opportunity to present their business plans to attendees, including LICA members, investors, business executives, and others. At each capital forum, we also host a panel of industry and investor experts who discuss the investment climate for presenting companies. LICA's capital forums are available to companies at various stages, including seed, early stage venture, late stage venture, private equity, public and public companies. LICA's capital forums have featured or may feature presenters in a variety of industries such as internet, software and technology, homeland security and defense, cybersecurity, social media, healthcare, biotech and pharma, retail and consumer products, and cannabis. We provide a venue for local companies to achieve their growth goals. In addition to providing access to capital, we also facilitate introduction of experienced entrepreneurs, executives, and service providers to growth companies which require their services. LICA's capital forums are also a great networking event for Long Island professionals and entrepreneurs. As Lexi said, my name is Eric Allstetter. I'm this morning's facilitator. I'm an audit partner with Eisner Amper LLP and the treasurer of the Long Island Capital Alliance. I have worked with public companies and privately held businesses throughout the country for over 30 years. I have helped numerous clients through the complex financial reporting and compliance issues associated with the filing of registration statements with the Securities and Exchange Commission and raising capital from other sources. My industry experience is with companies in the financial services, technology, manufacturing, distribution, cannabis, and retail industries. I speak frequently on accounting, auditing, and business topics and have been recognized by the Long Island Business News in their Who's Who in accounting and audit editions. And let me introduce you now to the rest of our panel. Corey Masella has over 25 years of experience as an entrepreneur, tax and business advisor, and as a specialist in SEC accounting and audit services. Additionally, Corey has experience as a private equity and technology industry group practice leader for a top 20 accounting firm. Corey has successfully guided his clients through all facets of the merger and acquisition transaction cycle to help them make critical decisions while ensuring transactions are strategic and seamless. In 2015, he was selected as the winner of the Smart CEO Award for Industry CPA Leader in New York City. Corey has completed over 300 M&A transactions and was the lead partner at the firm awarded M&A's Advisors Accounting Due Diligence Firm of the Year Award in 2017, as well as being nominated as the Deal Maker of the Year by ACG New York and M&A Advisor. Corey is also the president of the Long Island Capital Alliance. One of our other speakers is Mark Lenoitz. Mark is a Wall Street veteran with over 29 years experience. He co-founded a boutique investment bank that was based in Manhattan and its online capital formation platform Bank, both of which have been instrumental in laying down the framework for Regulation A+ and crowdfunding offerings. The methodology Mark structured is what led to the first successful Reg A+ IPO to list on a national securities exchange, the New York Stock Exchange, with other Reg A+ offerings following that blazing trail. He is a noted speaker at small cap and Reg A events, including the SEC Small Business Forum, and has been profiled in Businessweek, CNBC, and several other publications. Mark is also a member of the board of the Long Island Capital Alliance. Our final panelist is Neil Kaufman. Neil Kaufman is the managing member of Kaufman McGowan PLLC. Neil represents emerging growth, middle market, and public companies and investment firms in their corporate securities, financing, borrowing, merger and acquisition, and other legal matters. Neil is particularly well known for advising clients with respect to SEC regulations, public offerings, private placements, and mergers and acquisitions, as well as all types of commercial contracts. He is a frequent speaker on corporate securities and cannabis law topics, and is an approved Vistage speaker on mergers and acquisitions. He serves as a member of the Board of Trustees and chairman of the Audit Committee of iCapital KKR Private Markets Fund. He is a member of the Board of Trustees and chairman of the Audit Committee of Two Road Share Trust. He is chairman also of the Long Island Capital Alliance, chairman emeritus of the Long Island Capital Alliance, and chairman of the Long Island Chapter of Financial Executives International. Neil received his JD from New York University School of Law in 1984, where he was a staff member of the Journal of International Law and Politics, and his BA from Binghamton University in 1981 with recognition for outstanding academic performance. So what we'll do now is Corey will spend a few minutes going over a general state of the markets with respect to capital raising. Then Mark will discuss current methods of capital raising, such as crowdfunding, Reg A+, Reg CF, and Rule 506C. And then Neil will discuss what you need to do to complete a capital raise and what entrepreneurs can do to plan ahead. And then, as always, as Lexi mentioned when we started, if you have any questions, please submit them using the Q&A widget on your screen, and we'll try to address them during the presentation. We're going to leave some minutes at the end of the presentation for questions and answers. So with that, Corey, why don't you talk about the status of the markets?
Thank you, Eric. Thanks. You know, those are pretty heavy accolades for the three of us. Whether it's true or not is another story, but we won't go there. So let me lead with, as Eric said, my discussion is going to be about the general state of capital raising, and I'll be focusing on emerging companies and the various stages of funding, which would be like Series A, B, and C, angels versus VCs, and private versus public markets. As everyone knows, COVID has had an effect over the last year on when and where the capital has been going. What we've seen is a lot of money, and I'm going to stay in the positive realm of about money is flowing and where it is flowing. So we've seen a lot of money that is being deployed since the summer of 2020, after COVID kind of leveled off. There's been a lot of capital available, and the investments have been very targeted. For certain of these target markets, it has been competitive and valuations have increased. Many of these targets are the result of the new norm. Many are focused on the future of work. Some of them are companies that are supporting the transformation to cloud computing, cybersecurity, those that are doing e-commerce, ed tech, mobility automation, new connectivity, SaaS, fintech, and infrastructure support. Now, look, remember, there's probably some more. I'm not hitting everything, but these are the observations that we've seen, on my end of what has been happening. Another big focus has been on healthcare. Examples of what's going on in healthcare that are really getting supported in a lot of capital raise is telehealth. Telehealth is completely accelerated as a result of COVID. It was always out there, but now the adoption has happened, and so a lot of money is being deployed there. Essential businesses, again, everything is related to COVID and the changes in behavior amongst everybody during these times. And this kind of goes global too, by the way. Food services, distribution, and logistics, and believe it or not, things that relate back to grocery stores. So a lot of this is these ancillaries that are around these industries that are being funded. Life sciences and biosciences is also hot. Medical testing, genetic engineering, a lot of money is being deployed in that area too. So, as I said, the remote distribution workforce is having a major effect. I will also tell you, outside of companies being funded, what private equity has also been doing. They've been out there purchasing companies that support also these industries and this remote environment, as they see it's not a temporary situation. and it'll be a little baffling, but you're talking about HVAC companies, HVAC companies. Those are supporting refrigeration, fire prevention, companies that provide support to larger service centers, value-added resellers and software support centers, companies that are more focused. Because remember, they've got to deploy money, so they're finding areas that their risks are lower, or where there's adoption and there's a long-term play. Clinical labs have accelerated. Some of them were down during COVID. Some of them are up 50, 60%. And home improvements. Everybody knows people have been home. They've been spending money on home improvements. We've also seen that larger amounts are coming in on Series A rounds. They've been around $5 to $10 million. They've been in the higher range. Series Bs have been closer to 20 million, and Series Cs have been above 20 million. So the commitments and the money is flowing in at higher levels. We are seeing follow-on investments by many of the same investor groups that did the first rounds, or whether it's the B or the A, but they're coming in and they're coming in and following on. If you're fortunate enough to get to the Series C round, it begins to get competitive amongst the VC groups. You've actually got the edge. And so the private companies now currently in this environment have got the edge if you're in these industries I'm referring to. Also, I mean, I don't know, everybody's got to know this. Many of these companies have been approached by SPACs, which have been around. SPACs have been around for a very long time. And they came back into vogue about 3 to 4 years ago. Large firms like Blackstone and others began using them for large acquisitions as a faster way to go public. One example was about 3 to 4 years ago, a gentleman, his name is Chin Chu, we do work for him. He spun out of Blackstone. He went out there and he did a SPAC. That SPAC was able to raise $1 billion, and a lot of follow-on money came in. They went out and bought D&B. Apollo did this. A lot of the big guys did this because it was a faster way to get the deals done. And in the SPACs, you've always got a lead group that everybody's backing to find an acquisition and a target. So that was the origination of the genesis of where we are today, which I'm going to get to. Valuations have been very high in the public markets. So many private companies think that they are the next unicorn and can use the public markets for easy access to money and for mergers. Now, the number and the dollar amount of SPACs has hit record numbers in the past year. Some of the SPACs that we have seen that have occurred are companies in the e-commerce space, auto parts companies. Believe it or not, an auto part company that was private, that was during COVID, their sales increased 35%. They were approached by a SPAC and they merged into a SPAC. Another company during COVID, people are buying plants online, more adoption. That's another example. And then 5G mobility applications. That's another group that is in the lower tier. In lower tier, I don't mean, you're talking about hundreds of millions of dollars on the acquisitions. But this is the lower tier, not the, the type of deals that Blackstone and the $1 billion ones that you see profiled in the papers of these higher level tech companies that are getting $1 billion deals done. So what are the pros and cons of SPACs? It's one of the easiest ways to go public, to go from private to public and have the availability of the public markets. Some VCs are not fans of their portfolio companies going down this route. Some of the reasons are sometimes it is too early, and in the public market, everything is transparent. So all the trade secrets and how business is conducted gets out there. There is also a significant ownership dilution by the private company as the formation the formation sponsors of a SPAC, as I alluded to before, get a nice chunk for doing the sponsorship, so that it does affect, versus if you were to do a traditional IPO. On the plus side being that you know, if you're dealing with the right sponsor and the sponsor group, it can accelerate your business and give you increased PR and credibility to the public. But again, if you're not connected to, you know, it depends upon the company you are, who your VCs are. You know, does it make sense to go down the SPAC route, and all the sponsors in that SPAC going to help you significantly? The last piece I want to say is that, as I alluded to before, if you're in the industries that I'm saying are hot, you do have the ability to select your investors, and you really want to pick your investors carefully, and those that are going to help you and partner with you. So know that you have that leverage right now, and utilize it while you can. So on that note, I'm going to give it back to Eric, and Mark and Neil are going to get into alternative capital raises, which is outside of what I just discussed.
Thanks,
Eric?
Corey. Thanks for those comments. And Mark, a few years ago, the SEC changed certain rules, relaxing certain capital raising rules. So why don't you discuss the current methods of raising capital, such as crowdfunding, Reg A+, Reg CF, and Rule 506C for us?
Thank you, Eric. So as Corey just said, he's talked a little bit about the marketplace and the various trends that we're seeing here for capital formation. And specifically when he was talking about SPACs, it's an exciting new area of the marketplace, but that's really designed for companies that have enterprise values of 400 million or above. Because without that, SPAC doesn't make much sense from a dilution standpoint and for the amount of money that's in that SPAC to make the acquisition. So what do you do if you're an emerging company? What do you do if you're a startup or a small business? How can you raise capital, and how can you do it in a legal manner? And that's one of the things that we saw change in 2012. Congress passed what's known as the Jobs Act. And the Jobs Act was basically the ability to create new ways and innovative techniques for capital formation for early stage companies to finally utilize a more modern technique. Historically, when a company was looking to raise capital, they would go through various cycles. They would do a friends and family round and pass the hat. As they evolved, as Corey mentioned, they would do a Series A or B or C. But one of the things in the misconceptions was that these issuers would go out, and anybody that they would talk to, they would be excited to tell their story and look to have those investors participate in their particular business. Unfortunately, that was a violation of securities laws. You can't go out and use the term called general solicitation to be able to tell everyone and to be loud and proud and be able to talk about your business and invite them to participate. And you'd have to have a pre-existing relationship. And what ended up happening too is people didn't understand that you need to be what's known as an accredited investor, which means that you have to have $1 million net worth and an annual income greater than $200,000 to even be able to participate. Well, Jobs Act changed that. And what it did is it allowed these new entrepreneurs to be able to go out and use modern techniques like Facebook and Instagram and social media and other techniques in order to drive interest and be able to allow investors now to hear the story, but more importantly, to be able to invest in it. And you only needed to be 18 years old. There were some limitations. You can only invest 10% of your income or net worth, but it still opened the doors where these entrepreneurs could now go out and take their customers, their affinity groups, their followers, and make those people shareholders. So it was something that we found to be very exciting because you're actually taking two bites of the apple. You're taking investors and making them brand ambassadors that we're going to go out and be able to communicate what's so exciting about your company, and at the same time be able to increase your sales and revenue by taking these investors and making them customers. So it's exciting to be able to have a customer become an investor and an investor become a customer. There were three main areas of the Jobs Act that got people excited. There was what's known as Title II, which is the general solicitation of private placements. It's known as 506C. And what this means is that you could go out now and put an ad in Times Square or put an ad in the newspaper and be able to invite people to look at your opportunity and participate. This is known, though, as a private placement. What's different is that you're now allowed to tell everyone about it, but you still could only attract accredited investors to participate. And that was something exciting because there was no limit in the amount of money that you could raise. There was something then called Title III, which is Reg CF, regulation crowdfunding, which allows you now to be able to, up until actually this past weekend, or on the 15th, to raise up to $1 million. That just changed to now $5 million. And that is where you can allow anyone who's over 15 to be able to participate. And that's what I was talking about, making these customers your investors. But those types of offerings can only be done on a platform, and it's known as a Regulation CF platform or a crowdfunding platform. Right now, there are 54 of them in the United States that are registered with FINRA and the SEC. And these are platforms that you might have heard of called Start Engine or WeFunder or Republic or Seeders or Seed Invest. And these platforms are designed to allow your company to be presented in their platform along with all the other companies they work with, and to be able to attract the investors that are part of that platform that want to participate in your opportunity. The other thing that we saw then was what's called Title IV. And what Eric had talked about was that I had created the methodology for Title IV, which is known as Reg A+, to allow these securities to trade on a national securities exchange to allow liquidity. And I'm going to go over some of the pros and cons of each in a moment. But what's exciting about Reg A+ is these types of offerings could actually be hosted directly on your own website. And it's not required to use an intermediary or a broker dealer to solicit investors to participate. And up until the 15th, you were able to raise up to 50 million. That law just changed like Reg CF, so now you can raise up to 75 million from non-accredited investors across all 50 states using modern techniques, like I mentioned, using social media and digital offerings and other types of communication using full general solicitation. So this was something that we were really excited about because it really finally opened the doors for capital formation for these entrepreneurs to be able to communicate their story and attract investors legally. We've seen this now. This all really came to be in 2015. Reg A+ was approved. In 2016, Reg CF has been approved. During that time, we've seen over $2.4 billion raised for these types of offerings. About 2.2 billion of that was raised for Reg A+. About 200 million was for Reg CF. We've seen in the Reg CF market over 2,600 companies use this type of capital formation technique with over 3,000 offerings. And now that we've seen it increase to 5 million, I think we're going to start to see more and more of these things occur. What's great about it, and what's nice about crowdfunding, is that it's not very expensive to do. So it requires a filing that Neil's going to discuss in detail when he gets to the topic. But it basically, for a small amount of money, you can go and file with the SEC, and then you can go out and use this technique on one of these platforms to raise capital. Reg A+ is a little bit more expensive. It is a public offering. It requires what's called an offering circular, which is almost equivalent to an S-1 filing to be done with the SEC, where you're registering those securities, in essence, for primary issuance of the shares. When you look at these techniques, though, one thing you need to be really conscious is that you're now taking potentially thousands of investors. So it's important to look in the mirror and make sure that you're ready for that type of commitment. Unlike a private placement or the venture or VC rounds that Corey was discussing, where you're only taking in a few investors, you now have a responsibility to all of your shareholders. And with that number of shareholders that comes in, that's a great amount of responsibility and in essence, a time drag, because those investors are going to want constant updates. But the beauty, as I said, is that those investors now become your brand ambassadors and really could help your company grow and your business grow. What we're seeing, though, the other problem with Reg CF, and I think it's being solved, and the SEC is slowly adopting this, is the ability to have Reg CF shares trade in a secondary market. Currently, private placement shares are restricted. Reg CF shares are restricted for 12 months. After 12 months, it has the ability to be resold. Right now, there aren't any marketplaces other than a few small, what's known as ATSs, alternative trading systems, that allow some investors in a almost like a matching engine type scenario for those investors to be able to find other investors who might be interested and then make a bid and offer to make that trade. We are starting, though, to see that more and more broker dealers are becoming aware that the illiquidity needs to be solved, and the SEC has been soliciting comments, and the SEC has been slowly examining on how to create a more liquid marketplace for these investors to be able to get that liquidity they need. Reg A Plus, though, is a liquid marketplace. If the company decides to list on a national securities exchange like the New York or NASDAQ, or if they trade onto the OTC markets, which would provide liquidity to those investors. But any way you look at it, it's now a great opportunity for these entrepreneurs to be able to spread the word and be able to get those investors interested in their story and be able to now have new and exciting techniques in order to do capital formation. And the best part of it, as I said, is it's a lot less money than going through a full public offering. And it's an ideal situation when you're not quite ready to go on through a front door IPO or do a reverse merger through a SPAC. And it's a great way to be able to create additional capital and use it as a stepping stone to the next level of capital formation as you mature and grow. And with that, I'm going to turn it over to Neil, talk a little bit about the details, and then I'm happy to answer any questions and details about how Reg CF and Reg A Plus works.
Thank you, Mark. So I really want to discuss two levels of topics following up on Mark and Corey's discussions this morning. One is how to prepare for these offerings, and two, a little bit about how the offerings work and what happens and what obligations issuers are subject to post-offering, including follow-on SEC filing requirements. So first of all, with respect to how do you prepare for and execute any of these offerings, that is a super critical challenge for a lot of companies, especially for a lot of smaller and emerging companies that don't have the kind of infrastructure internally and are not accustomed to the scrutiny of the SEC or the marketplace. Getting those companies cleaned up and ready to access the capital markets is often a challenge. And so, I generally recommend companies that are considering accessing the capital markets through any of these mechanisms go through their own prophylactic due diligence process. That makes the process a lot less painful down the road, because if you don't do that, then as you go down the road, you hit all these potholes that delay the process and make it all the more agonizing. So, you need to have a management team. You need to get your corporate books and records in order. You need to understand your business and be prepared to make the varying levels of disclosure to investors and the public that are going to be required. That includes thinking through your financing plan and your use of proceeds, and getting ready to go through the due diligence process. In order to do that, you're going to need a team of professional advisors, which also unfortunately costs money. You're going to need accountants. You're going to need lawyers. If you're going to go, the Reg A or other public markets routes, you're going to need investor relations and other market advice. You're going to need to have relationships with broker dealers and other market participants. At the end of the day, no matter what route you take to the public markets, once you get there, running your stock is a full-time job in addition to running your company's business, and you need to be prepared for that process. So if you're going to breaking this into the three component parts that Mark was addressing, if you're going to do a 506C private placement through public means, that's going to have relatively scaled down back-end requirements, but you still need to be prepared to make disclosure of all material facts and not omit any material facts in the offering materials that you provide to investors. The real challenge with 506C public-private placements that I've seen in the several years that it's been around is that the issuer has an obligation to verify the accredited investor status of all the investors, and that has proven to be a significant logistical obstacle and a dissuading factor to many companies that might otherwise be inclined to take advantage of the general solicitation permissibility in connection with their otherwise private 506c offering. But as a technically private offering, the only SEC filing requirement is to file a Form D after the offering is complete, and there are no follow-on SEC filing obligations. So that's why 506c could be attractive, because you can use the means of public offering and general solicitation to raise the capital without being subject to SEC filing requirements. Now, for Reg CF offerings, which we hope will become more popular now that the limitation has been raised, that does require a filing with the SEC, although it's a much scaled down level of disclosure in the filing of your Form C. And the follow-on obligations with respect to SEC filings are also significantly scaled down. With respect to Reg A, in order to conduct a Reg A offering, you need to file a Form 1A with the SEC. The Form 1A itself has alternative disclosure methodologies available built into it. You can either file a scaled down Reg A level disclosure, or you can file S1 level disclosure on that Form 1A. Most of the deals I've seen have elected the S1 level. Most of these companies are smaller companies eligible for the smaller company reporting standards and the emerging growth company reduced report disclosure standards. So, there are some benefits to using the S1 level of disclosure, especially at the scale down level. So again, most of the ones I've done have opted for that route, although it's not required. So that Form 1A gets filed with the SEC. It can be filed confidentially. The SEC reviews it and ultimately qualifies the offering statement, allowing you to start selling your securities in your Reg A IPO. One of the critical things about a Reg A offering, though, is that you're also allowed to test the waters. So prior to your Form 1A being qualified, or even prior to filing your Form 1A, you're allowed to discuss the offering with investors orally and deliver written materials, and thereby test the waters to see if there really is the market for your company's securities that you think there may be. Once your Form 1A is qualified, you're allowed to start accepting investor capital. And it resembles very much like any other kind of IPO, where you can do it with or without an underwriter. Obviously, it's going to be it should be easier to raise money if you have an underwriter, and you also want to start planning for the public trading of your stock and lining up market participants to help you generate buying demand for your stock, so that you can maintain an orderly market for it after you've raised your money. There are many logistical steps depending on how you're going to conduct your offering. As Mark pointed out, you're not required to use a platform. You can, in theory, do it yourself on your own website. However, as a practical matter, it's much more manageable to use one of the established platforms like Mark's Bank platform and several others, where the administration of subscription agreements and funds that are submitted by investors that go into escrow, and all the technology is all sort of, managed and kept more manageable for the issuer in one spot. So again, most of the deals that I've participated in have used that type of process, although not all. Some issuers are capable of running it themselves. Some even accept subscriptions the old-fashioned way, with like regular non-internet subscription agreements and fund transmissions. So there's a lot of variety available to issuers. The process varies depending on how you want to do it and which way you want to do it. As far as follow-on reporting obligations, if you raise money in a Reg A, you become what we call a Reg A reporting company. Instead of filing full SEC reports and annual 10K, quarterly 10Qs, and periodic 8Ks, and becoming subject to the proxy rules and the Section 16 short swing profit rules, you become a scaled-down Reg A reporting company. You file an annual report, a semi-annual report that looks sort of like a 10Q, but it's only once a year. You have to file it mid-year, and you disclose fundamental changes and a scaled-down list of other material developments on Forms 1K. Now, that doesn't mean that you can't elect to become a full SEC reporting company. If you do a Reg A, you can either stay a Reg A reporting company, or you can elect to become a full SEC reporting company, which you'll generally need to do if you're going to get listed on a national securities exchange. But if you're going to trade on the OTC markets or otherwise, not on NASDAQ or the New York Stock Exchange, you can stay a Reg A reporting company. So that's a short summary of some of the nuts and bolts details. We're going to open this up to a Q&A. If anyone has any further questions, we can address them.
Okay, great. Thanks, Neil. We do have a slew of questions here, so let me start. Corey, you mentioned that you talked about SPACs, and it seems like SPACs are the only companies doing IPOs these days. What do you think of the recent market for SPACs?
I think that it's you got to know your sponsors. You got to vet them heavily. And, that's the key to everything. And there's a couple of companies that we're working with are out there marketing themselves to multiple SPACs. So you have that ability, but you do need to know your sponsors that are in the SPAC. And the same thing as if you were going to go with a VC and who invests in your company, you want the right partner. That, to me, that's the key. And what's the available dollars, and get your valuation right too, of course. That's rule number one. So those are my thoughts.
Okay, Mark.
Eric, I would just interject. I think that's a little bit of a misnomer that only SPACs are getting done. So clearly SPACs are dominating the conventional IPO market, but Mark and I are seeing tons of Reg A's that are not SPACs. And that market is thriving. So let's not be misled by the sort of conventional Wall Street wisdom that a SPAC is the only way to go public. That's all I wanted to say.
Your issue there is that SPACs are getting all the press right now.
Right.
and it's been listed every day. The three of us have all been around, and the four of us actually have all been around long enough that we've dealt with SPACs in the past. The question is, and what's out there is, when is the bubble going to burst? I don't mean to put any dark sense on this, but is it sustainable? Is still out there. And to Neil's point, there are still traditional IPOs happening, so don't discount that. So,
yeah, I mean, to add, as a banker who's active in the SPAC market, and I'm currently involved in several, a half a dozen of them. I can tell you that I'm also involved in 3 primary IPOs. SPACs, IPOs, reverse mergers, it's all a tool that needs to be identified and used in the proper manner for the right type of capital raise and issuance. There's a complete illusion around SPACs because it's in favor right now. It's made all the press. There's been over 500 of them that are out in the marketplace today. There's 174 that have been filed in the last several weeks, including several of the ones that I'm working on. And the reality is SPACs themselves really are very expensive shells because investors end up pulling out their capital. They don't have to go along with the transaction, which then defaults back to an issuer having to raise capital from the street, either through a PIPE or through the investment banker that's facilitating the merger. So as Corey said, it's important to find a right SPAC sponsor that has those relationships to bring them in. But to give a little background on what Neil was saying, we are seeing a big trend in Reg A+. Last year from July 1st, 2019 to June 30th, 2000, so this was kind of right at the beginning of COVID, during that time, we saw in the Reg A market over 1.3 billion raised, and that was done with an average raise of about 2.1 million. During that same time, this does not really include the SPACs because SPACs really kind of just got exciting. Now, we saw just in a traditional front door IPO about 60 billion raised. But again, it's really determining what type of company are you and where are you in your capital formation stage. If you're early stage, you're not doing a SPAC. If you're early stage, you're not doing an IPO. That's where Reg A and Reg CF really starts to come into play because the options to an early stage entrepreneur were somewhat limited. Now you have the ability to convert regular everyday individuals, the crowd, and allowing the crowd to be a participant in your success.
Yeah, Mark, I think dealing with SPACs have been around for a long time. They've always been called either reverse mergers or backdoor registrations. They really have exploded the last couple of years, and the size and just sheer number of them have just exploded recently, but they've been around for a very long time. This question is for Mark and then for Neil. What situations indicate that a Reg A, a Reg A Plus, or other type of funding is the right direction to go to?
I'll take the first stab and let Neil finish up on it. I think an entrepreneur needs to understand what their capital needs are and what responsibility comes with that. So most of the time when I take on a client and the ones that I work with in the Reg A and in the crowd finance marketplace, I like to work with companies that have a large affinity group, a customer base, or a large social media following. So I tend to work with consumer, hospitality, entertainment. I've worked with, I underwrote Fat Brands, which is Fat Burger, had a large following. We had over 8,000 investors participate and other issuers like that. Because it's important that when a customer looks at your story, they can understand that story in 30 seconds. Because what you're using is social media in order to convey your messaging. And that social media and the attention span of that particular investor is going to be somewhat limited. So you need to have a story that's going to resonate, something that somebody could relate with. So whether it's a liquor brand or something that's involved, that's not a complex widget. If you have to get into a story that you have to explain that you very well might have the next cure for cancer, but it's going to take you an hour to explain the molecular science behind why that gene or whatever it's going to be, you've already lost the investor. So it's important to use different types of techniques, using graphic techniques, using videos, using documentation that's going to be graphically attractive to get the eye of that investor on. And one of the other beautiful parts about Reg A Plus and Reg CF, and especially with what's going on in COVID, is the world of traditional IPOs, of walking up and down the street and doing a road show to select institutions and the kind of what I like to call the Wall Street elite. The beauty of Reg A Plus and being able to use videos is you can basically take the customer or take the investor and do a roadshow by bringing them directly to your site. So they can do their own due diligence and do their own virtual tour, because in a traditional IPO, you can't do that. You can't have a pre-recorded video, but in Reg A Plus, you can. So it's something that we're starting to see, as I said at the beginning, modern techniques for capital formation, where Wall Street used to be a paper and black and white prospectus. It's now a graphically attractive and video presentation in the modern world.
So following on to that, I think Mark makes a very important point that in a lot of ways, Reg A Plus and Reg CF are tailored for the social media world in which we live. But they're also, from my perspective, a more manageable on-ramp to accessing the public markets for a lot of companies than the traditional S1 IPO. And I've worked with consumer-facing companies like Mark is describing that are really built for that type of process, but also with pharma companies and cannabis companies and all kinds of companies that just find Reg A in particular a more manageable route to the public markets. And my caution about that is, if you're gonna go to the public markets, you need to be prepared to deal with the public markets. You need to have a business that's going to be understood by the public markets and valued by the public markets, and you need to be prepared to play in that sandbox. So, as I alluded to earlier, that's a full-time job and is a challenge. It's not for everyone. You need to understand and be able to implement transparency, disclosure, and some market sophistication that is not right for every company. But if you are able to manage that, then it is a pathway with less friction to the public markets.
Yeah, I just wanted to add one thing, to you, Neil, to your point, which is excellent. If you're going to go down the public route, you have got to be ready that you have got a projection and a story that is going to continue to bring valuations up, because it's all about PR and how your stock's going to trade. So it's not a present story. You've got to be, you got to be thinking long. So I would just add that.
Yeah. Neil, just to follow up
short, I think.
Neil, to follow up on what you were saying, when a company's planning to do this significant capital raise, how long in advance of that time should they begin the planning? How long is the process?
Well, Eric, I guess I would say it's always longer than you think it's going to be. It's not uncommon for people to show up in my inbox, so usually in my inbox at my proverbial door, and say, I want to do a Reg A and I want to have my money in 2 months. Well, that doesn't happen, right? You need to get yourself ready as a company. You need to get a Form 1A prepared. You need to go through the due diligence process with your lawyers, with your bankers. You need to get an audit and get that completed, and that is usually at the risk of offending Eric and Corey. We've got two CPAs on the phone. Usually the audit's the last thing done. Just always seems to take the longest. Not always, but usually. And so you have to go through an audit process. Most of these companies have never been through an audit before. And, the first audit for any company is painful and takes longer and costs more than you think it will. So I would say, if you're going to do a Reg A, you have to figure, I'm doing one right now, and I think we're about to file. It's been about 2 to 2.5 months since the initial planning began. And I think that's actually relatively quick as these processes go. And then you have to tack on another 45 to 60 days minimum, oftentimes more, to get through the SEC process. So you have to anticipate, I think, at a minimum 4 to 6 months process from planning to capital in hand. Mark, do you agree with that assessment?
Yeah, actually, I want to point something out that's actually really exciting about Reg A Plus. So, as Neil just said, there's a lot of time, effort, money that goes in planning in order to facilitate a Reg A Plus. I get a lot of companies that come to me that think they have the greatest idea. The entrepreneur is really excited about it. They think the market's going to accept it. The beauty is now under Reg A Plus, you can do something what's called test the waters. So before you go out and spend all of this time and effort of going through the process of actually doing the offering circular and filing with the SEC, you can go out and you can put on your website, hey, or in your restaurant that somebody's come in, you loved our food, and now would you want to be an owner? You want to be a part of our success? And you can now gauge the market's interest through the test the waters phase before you spend that capital. So if you go out and you put this on your website, or you send it out to your email list and you say, you've always been a supporter, now you have a chance to own a piece, would you be interested? You can gather that intelligence and then make an informed decision, because where you might think you have this great idea, the market might not think that's the case. And then the opposite could occur, that you might have thought you were only going to raise $1 million or $2 million, and you put it out there and you see now that you have the ability to raise a lot more. And one of the things that we've seen, and one of the questions that came in is we saw on March 15th that Reg A Plus has changed from 50 million to 75, and that crowdfunding has now gone from $1.070 million to $5 million. The beauty of seeing the increase to 75 million is for a larger company, maybe that somebody's doing real estate where you want to have fractional ownership and allow the crowd, in essence, to own a piece of a building. You can go out now and do bigger raises, be able to get more capital all the way up to 75 million. And again, using that test the waters, you can gauge the interest before you have that expense going out.
And Mark, just one question. Wait, can I just say something quickly? To Mark's team and Neil's team about testing the waters. At the same time, from a professional standpoint, and this is done, we do this. I'm sure Eric does this too. Get us involved early, 3 to 4 months before you even getting there, so we can do a SWOT and let you know what you got to work on from a time frame. So that's the only thing I wanted to say. It's testing the waters and also engaging professionals where you don't have to hire us, but at least you're getting a sense of what we're seeing.
And to piggyback on that, the one caution I just want to throw out there about testing the waters, which is obviously an extremely useful process, is be careful what you rush out there with to test the waters with, because I see a lot of sloppiness in investor decks that are used before companies go through the vetting process, before they've engaged their accountants or their lawyers. They're slapping things together and distributing a deck. The problem is, the challenge we have is that if the testing the waters materials materially differs from what ends up being in your Form 1A offering statement, after you've gone through the due diligence scrubbing process, it has to be filed as an exhibit to your Form 1A, and then it's out there on the internet for all the plaintiffs' lawyers to see. So, it just can create unnecessary disclosure.
Forward-looking statements, you put in projections, you put in irrational statements, that will be held against you. So definitely.
Exactly. So just be careful.
Yeah.
Yeah, one of the advantages in the item that Corey was talking about earlier was the SPAC, is the speed in which the SPACs can kind of register and get listed, because there's really no activity. So the audit process, as Neil was alluding to, isn't as long as onerous, because there's no real operations in the company. So that's why the SPACs have become in vogue of late, and they're just raising a tremendous amount of capital. The next
Eric,
question, I guess,
there's more to it also. So good.
Yep.
No, the key thing about the SPAC is they raise a big bucket of capital, and then just like a private equity fund, they can leverage that equity capital 3-4 times. And so if you have a SPAC that raises $500 million, well, they can now do a $3 billion acquisition. And so it puts, with a significant cash component, it gives them a major advantage in soliciting target companies to acquire, because unlike other public companies that may not have as much cash, they can pay a large cash component to their target, their acquired companies, while still having the ability to offer public company stocks. So I just wanted to explain that's part of the reason why I think SPACs are so popular.
Yeah, and Neil, that was what I was alluding to when I went back to the Blackstone days. The $1 billion in cash raised buying D&B, the valuation was not $1 billion; it's like $4 billion. To Neil's point. So
sure, leverage. Sorry,
and gentlemen, in this whole process, our clients generally build up a team of professionals to assist them in this process. It could be attorneys, it could be auditors, it could be investment bankers, it could be IR firms. Corey, why don't you start and talk about how important this team is to the process?
Oh, there's no doubt about it. I mean, look, as we said, partnering with the right sponsor, or the bankers, the IR people are critical. To my point earlier, that you've got to have somebody who's going to get it out to the public and keep your valuations and your stock price, up at a level. You've got to support it with the right story. Your accountants and your lawyers have got to be seasoned, a lot of experience. They got to be able to work cohesively, and at the same time, you've got to be dealing with the professionals that you feel comfortable with, because again, they're your partners, and you're hoping they're going to go long and they're giving you the right information to meet your expectations, whatever that may be, that they're going to work within that time frame, and communicative, and educating you. I think that is a really key piece. So,
Mark, any thoughts?
I think it's really important that you don't fall victim to the LinkedIn expert. I used to say that I would sit on panels, I would sit at events, and I was usually one of the only regulated people, and everybody else on the panel were experts because they said they were on LinkedIn, but they had never really done a deal. And we're starting to see this not only with crowdfunding, with Reg A, and now everything that's going on in the crypto world and security tokens and blockchain. So I think it's important that you identify a team that actually has experience in capital markets, in securities law, in public accounting, and all of the aspects that go into disclosure. And your IR firm is going to be important too, because a local PR firm won't understand what can and cannot be said in a securities offering. So these are securities offerings. You are taking in investors who you have now a fiduciary responsibility. So it's important that you disclose your information in a clear, concise, and fair and balanced manner. So having a team of professionals that know how to communicate that and what you can and cannot say is really important, because if you run afoul, it's going to create a big issue for you down the line, and it's going to take all the hard work and effort that you did. And sometimes it will also invalidate your offering. So it's important that you have the right team around you, just like what Corey had said.
Yeah, there's also the time factor, and doing 10, doing 20, doing 50 sometimes is not enough. You've got to be dealing with professionals that have really got the experience all around.
Well, I hope if you've done 50 of them, that's enough experience, Corey.
Not necessarily, Neil, right?
You'd have to be pretty dumb to not know how to do it after 50, but anyway.
All right. Now, gentlemen, we only have a couple more minutes, so I guess the last question I want to ask all three of you, have you seen, I guess, what changes or trends do you expect to see in the area of capital raising in the coming couple of years? Neil, do you want to start with that question?
Well, I wish I had that crystal ball, because then I could play the derivatives market and make a fortune. I think we're going to see a continued growth in the Reg A marketplace. We may see now more activity in the crowdfunding Reg CF world now that the maximum has been increased from 1 to 5 million. I think we're starting to see Reg A being more accepted in the marketplace to a considerable extent. I mean, 20 years ago, people didn't really want to look at Reg A's. They were looked down on as being the province of stock promoters and pump and dumps. But I think that it's really been legitimized over the last few years, and that's a huge step forward, together with the blue sky preemption that comes with it nowadays. It's really created that pathway. I still don't see, the 506C public-private offerings gaining traction unless and until that accredited investor verification process is made more manageable. Will SPACs flame out? I don't know. I mean, I think so many people are so vested in that right now that absent some kind of major scandal, I don't see any real reason for that to abate. All of that depends on what happens in the markets generally. We're likely to have an economic boom for the next few years coming out of the COVID pandemic. And if the markets continue along with that, this may all be just a tremendous run for the next few years. Maybe the greatest ever.
Mark, in our last couple of seconds, could you give us your thoughts on the future?
I think we're actually entering into a very exciting time for small capital formation. I think we're entering into a market place of what I call democracy, basically DeFi allowing investors now to be able to participate in offerings. We're starting to see direct listings onto national securities exchanges without the use of investment banks. It's contrarian to what I do in my day job. But I think what we're finding more and more is that investors, and what we saw here with GameStop and some of those other things that are just absolutely insane in the market, but what it really signals is that the power of the crowd is important, and it's finally leveling the playing field. So Reg CF, Reg A Plus is allowing the crowd to participate. I think some of the future things that we're going to see is more related to the blockchain and seeing offerings done in immutable blockchain type fashion. The SEC and FINRA have been very slow, rightfully so, to adopt security tokens and other types of issuances. We're seeing a lot of now irrational exuberance around NFTs in the last week, which are non-fungible tokens. So we're seeing a modernization. The one thing, and I know this wasn't really a SPAC conversation, I didn't want to get into a debate with Corey or Neil on this, but I actually think the SPAC market is coming to an end in the sense of creating SPACs, which again is something I'm active in, which unfortunately goes against my business. But where I see a huge opportunity, and I think that really the target audience of this webinar are entrepreneurs and companies that are looking to raise capital. Without understanding truly what a SPAC is, these are companies, anything that has a SPAC that has raised over $200 million, assuming there's not redemptions, the enterprise value of the company that needs to be merged is a minimum of 5 times. So you're talking really on the lowest end of a 500 to 600 million enterprise value up to multi-billion. How many companies exist in the marketplace? How many M&A bankers are around that can actually facilitate those mergers? Not very much. But what really happens in the SPAC market is there's 90 institutions that fund most of them, and they redeem. So at the time of de-SPACing, there's not a lot of cash. There lies the opportunity. So all these companies that are looking to come public or come public through a SPAC suddenly will be faced with over 500 SPACs looking for acquisitions. They're competing against each other. So you'll have a better chance of being able to find a SPAC to merge with, because that SPAC is going to be desperate. The one thing that people don't realize is if a SPAC doesn't complete a merger within 24 months or with a slight extension, the sponsor that puts up anywhere from $4 to $10 million to create that SPAC loses it all. That's a lot of incentive to get a deal done, which means that all these private companies have a great opportunity to come public that way.
So Mark, I wanted to let you know, I think it's frothy too on the SPAC side. So I agree with you 100%. And the last piece I wanted to just add is, I think that you hit it. You brought up GameStop and behavior and the maturity of people that now have a lot of money. A lot of these entrepreneurs that have exited, that are at younger than the 4 of us, that are sitting with money in the social media aspect of what's out there. It's a right time to raise what you and Neil are alluding to. And it's going to continue and become more robust, I believe. I agree with you guys in the future, because the behavior is out there and the money's out there now, and it's been built up. So. Okay,
well, I think we reached our time limit. So everyone, thank you for attending today's session. I think our panelists have given everyone a lot to think about. I think one of the biggest takeaways is this process does take time. It requires entrepreneurs to carefully plan and have a strong team of consultants to work with. A big thank you to our panelists, and please look for future Long Island Capital Alliance events. We do expect to resume our schedule of live capital forums later this year. I'm going to turn it over to Lexi, and have a good day, everyone.
Thank you for taking the time to join us, and we hope you enjoyed today's presentation on Long Island Capital Alliance, Innovative Ways to Raise Capital. A special thanks to our speakers today for delivering this insightful program. The recording of today's session will be available on demand later today and can be accessed using the same link you used to join. We would appreciate if you would complete our evaluation survey, which will pop up at the conclusion of this presentation, so please keep this window open. Thank you for joining our webcast today.